it's a contract, right? So it's an option to buy the stock, but at a particular price. So so it derives from the stock, but it doesn't belong to the company. It's a separate market that operates separate to the company. So you're not buying any sense of ownership. It's basically speculation. My understanding is based on two people like in a market, one saying both of them want to trade an apple, and one of them says, I will buy the apple when the price hits $1. The other guy says, but I want to sell the apple when it goes to 90 cents. And then it goes up and down in the market. And there's like a time limit, like chess. When they play time chess, you got 5 minutes. And if in 5 minutes it goes to $1, great. You get the contract. So you don't get the stock, but you win the contract. So we're betting for the right to get the contract. And that's the derivative. And the derivative has a correlation, but it's not, you don't own Tesla. It's just people betting like side bets. So basically it's like there's a main room and then there's a side room, and the main room is regulated and it's a stock being like, I can buy shares in Tesla, I can buy shares, and it's all official. And then options is like the other side room saying, I bet Tesla's going to go up to this price. No, I bet Tesla's going to sell at this price. And that's way bigger because it's regulated, but much less regulated. And because more people can speculate than own, it means that this market's going to be bigger, because it's like having a ticket to an event, but then there's all the people outside who are guessing what's going to happen, and that's its own separate economy to the one inside the park. This is my understanding from what I read, basically.
Yeah.
Hold on, I've got to check something now from my understanding. Tell me the difference now between futures and options, because they're both derivatives. How do they differ from each other, and what is futures in this context? 1 second, I'm just going to read this to help me understand. Tell me how futures contract is an agreement between to buy a set asset at a fixed price for a specific date in the future. Like options.
Okay.
Give me a second. So basically, a future is a promise, and a contract is kind of a bet. But when you promise, key difference is you must buy or sell the asset. You have the right, but not the obligation. Yet no upfront cost for futures. You pay a premium to buy an option. Potential profits unlimited, but you must fulfill the contract. Limited to the premium investment if it expires. Limited to your buy, you could lose more than your initial deposit. Limited hedging. Farmers locking in crop prices. Speculation used for speculation. Expiration. Either in cash, options can expire. A farmer and a bakery agree on what futures contract. Wheat futures contract at $500 per month for delivery in 3 months. If wheat rises to $600 per ton, the farmer loses because they are obligated to sell at $500. The bakery gains because they get cheaper wheat, $400, and farmer gains by selling at $500. The weekly loses because they're paying above. You can buy a call option to buy wheat at $500 per ton, paying a premium of $20. If wheat rises $600, you profit by exercising option and buying at $500 and selling at $600. Wheat fall below you option. You let the option losing only. Okay.
Just